Hello everyone, Steve Ribble here with Straight Mind Taxes, bringing you a presentation today on Section 105 plans, also known as Medical Expense Reimbursement Plans. Let's start with a few statistics. Americans spent over $2.6 trillion on healthcare costs in 2010. That's up over 10 times the $256 billion that they spent back in 1980. Now, it's no secret that healthcare costs are rising faster than just about any other expense we pay. The tax code does offer some help for those costs, but probably not as much as you think. If you pay for your own health insurance, you can deduct it as an adjustment to income on page 1 of Form 1040. If you itemize deductions, you can deduct unreimbursed medical and dental expenses on Schedule A, only if they total more than 7.5% of your adjusted gross income. If you pay alternative minimum tax or AMT, that threshold is even higher at 10%. But most of us don't spend that much of our income on health care, so we don't get any tax help. Let's look at a quick example. Here's an individual that had $10,000 of unreimbursed medical and dental expenses. They have an adjusted gross income of $100,000. This means on Schedule A, they're able to deduct $2,500 of their actual expenses. What this also means is that they're missing out on $7,500 that they had spent in deductions. Now, is there a way to write off 100% of your out-of-pocket medical cost as a business expense? Well, there is, and it's called the Medical Expense Reimbursement Plan, or Section 105 plans. The Section 105 plan is an employee benefit plan. That means that someone needs to qualify as an employee. The problem is, if you run your business as a sole proprietorship, which also includes single-member LLCs, a partnership, or an S corporation, you're considered self-employed in the eyes of the IRS, and you can't get benefits from this plan. So you have to figure out another way to qualify. If you're a sole proprietor or a single-member LLC taxed as a proprietorship, and you're married, you can hire your spouse. If you're a partner in a partnership or an LLC taxed as a partnership, you can hire your spouse so long as they don't own more than 10% of the business. If you're a shareholder in an S corporation, you don't qualify and your spouse doesn't qualify. Your best bet in that situation is to segregate part of your income into a separate entity, such as a proprietorship or a C corporation, and run their plan through that entity. Finally, if you run your business or even just a part of your overall business as a C corporation, you do qualify as an employee all by yourself. By the way, you can also use the 105 plan for family members other than your spouse. Let's say you're a single mom working as a real estate agent. You can hire your teenage child and use the plan to pay for their eyeglasses, their braces, or other medical costs. You can even hire a retired parent to help them cover their medical costs. The plan has to cover all eligible employees. You can't cover just yourself or your family and exclude everyone else. However, there are several safe harbors you can use to limit coverage. Specifically, you can exclude employees under the age of 25, employees working less than 35 hours a week, employees working less than 9 months per year, and employees who have worked for you for less than 3 years. There are a couple of other exclusions for larger employees, and the IRS doesn't pay a whole lot of attention in this area. But the fact remains that you do have to cover all employees. So if you have non-family employees and can't exclude them under one of these rules, the 105 plan may not be appropriate for you. Now for the benefit. Once you qualify, the plan lets you reimburse your employee for all medical expenses they incur for themselves, their spouse, and their dependents. Let's say you're a married sole proprietor and you hire your spouse. You can reimburse them for all medical expenses they incur for themselves, their spouse, which means you, and your dependents. Now you've taken what would probably have been a non-deductible personal expense and converted it into a deductible business expense. You've avoided that 7.5% floor on itemized deductions. And if you pay self-employment tax on your net income, you'll even avoid paying self-employment tax on the money you deduct through the 105 plan. That's another 15% savings on your self-employed income. What exactly can you deduct? Well, pretty much everything you can think of. That includes all the expenses you see listed here. Major medical insurance, long-term care coverage, Medicare Part B and D coverage, and Medigap insurance. Co-pays, deductibles, and prescriptions, dental, vision, and chiropractic care, big-ticket expenses like braces for your kids' teeth, LASIK surgery for your eyes, fertility treatments, and special schools for learning disabled children. You can even reimburse for non-prescription medications, vitamins, and herbal supplements, and medical supplies. The best part is this is money you would have spent anyway, whether you get to deduct it or not. You're just moving it from a non-deductible place on your return to a deductible place. Now, what is required to set up a Section 105 plan? You're going to need a written plan document which Shrink My Taxes can provide you. You'll need to make sure the benefits you pay are reasonable compensation for the work your employee does. If your teenager stuffs a few envelopes for you, the IRS is going to have a hard time believing that a full set of braces is reasonable compensation for that little bit of work. You'll need to verify the work your employee does in order to establish that the benefits you pay are reasonable compensation. Finally, you'll need to establish a paper trail to verify payment. This means tracking expenses, of course. It also means reimbursing your employee out of the business or paying their expenses directly out of the business. It's not enough just to pay your family's expenses out of personal funds, total them up, and deduct them at the end of the year. A couple of recent tax court cases have established that you really do need to establish a business link to those expenses. There's no special reporting required. You'll report reimbursements as employee benefits on Schedule C, Form 1065, or Form 1120. You'll save income tax and self-employment tax. There's no pre-funding required. You don't have to open a special account like with health savings accounts or flex spending plans. You don't have to decide ahead of time how much to contribute, and there's no use it or lose it rule. The plan is really just an accounting device that lets you characterize your family medical bills as business expenses. How can Shrink My Taxes help? Well, we offer a Section 105 plan kit for $200. This includes the plan document, the employee enrollment forms, the medical expense reimbursement forms, and the employee contracts and agreements. We also offer the consultation on implementation of this plan throughout the process. If you need to incorporate in order to take advantage of a Section 105 plan, we do offer incorporation services. And finally, we offer accounting and income tax services if you need those. If you have any additional questions on a Section 105 plan and whether it makes sense for you in your situation, or if you would like to order the Section 105 plan kit, contact us at the phone number there, 813-746-8208, or you can reach out to us at info@shrinkmytaxes.com. We appreciate your time today, and we'll talk to you soon.